aren't many open enrollments for employers at this time of year. Like, there's a few, but there's not a whole lot.
I remember one of the local hospital system used to have an enrollment during this time of year.
Yeah, and I know some of the universities do.
Yeah, like a full year. Right. Oh, and then they have like a mid-year, like a fiscal year, I guess I should say, enrollment period, right?
Yeah, kind of like ours.
Yeah, I guess ours is sort of like that, isn't it? We have what, June? We are small group stuff is weird. Like we have June to June for health, and then we have I think it's September for dental and vision.
Is that right?
It is what it is on the small group side.
Yeah, but for larger employers, I know that there's also some school systems, some education systems that do theirs this time of year, in addition to some of the larger universities. But that's actually not what I wanted to talk about today, because a lot of people do open enrollment, October-y, November-y time. Yeah. And we have another insurance planning focus month later in the year. Yep. But May is also insurance planning month here at FP FOCO. And of course, last episode, we talked about property and casualty. So like home, auto, umbrella insurance. Mm-hmm. Today, I want to get into some of the other stuff. And some of this overlaps a little bit with employee benefits, depending on the employer, of course. But I want to get into life, disability, and long-term care insurance today.
Okay, so interesting. So life insurance, right, which we'll go through each of these little components. Disability, right, which is sort of that. Well, it's interesting because disability is again, we'll talk about it, but like that's the event that you're more likely to have happen when you're younger than, dying, right? So, yeah. And then long-term care, which is a form of health insurance, really, but it's also a very specific form of health insurance and covering a very specific need.
Yeah, and that's exactly what we're going to do today on Money and Taxes from BB to XYZ, the show where we break down a single money topic, or in this case, a few insurance topics, and explain how they could affect those across the generations, from baby boomers to X, Y, and Z. I'm Regina Neenan, certified financial planner and accredited behavioral finance professional.
And I'm Jason Speciner, certified financial planner and enrolled agent, and life insurance being the leadoff topic in our list of insurances we are covering today. Of course, as we all know, a life insurance policy will pay your beneficiaries a death benefit in the event that you pass away while the policy is still in force.
Yeah, and it's inevitable. None of us is going to live forever, but there are some different types of life insurance that can insure you forever or for a certain period of time. And I think we find ourselves most often insuring for a certain period of time as we make recommendations to our clients. We don't sell any types of insurance, but we help link our clients up with different agencies who can help out with that.
Yeah, the need, if you will, in this scenario really depends on what specifically you're trying to accomplish with those dollars, right? So early on in life, right, you have a mortgage, you have kids, you have all these, scenarios where there's going to be some sort of financial dependency, some sort of financial need. And if you're not there, if you're not earning that income, et cetera, like that's going to impair that. That's really where you look at enhancing and increasing your coverage with potentially policies that aren't designed to last your entire lifetime. And these would be called, of course, term policies, or, a certain period of time, 5, 10, 15, 20-year term coverage.
And one of the most common ones that we see is 30-year term that would cover, a 30-year mortgage.
Yeah, there you go.
Or, maybe a 30-year, a 20-year, a 10-year kind of lumped onto each other, because you have a lot more of a mortgage to cover in that first 10 years if something was to happen to you. And you might not want to leave your spouse with that full balance to take care of if you're not around to help with those regular monthly mortgage payments.
Yeah, and you could probably do that with a good 30-year term and just decrease the death benefit, right, as you go along, and see if the insurer will work with you that way. It's a policy provision you may want to investigate as you apply for that type of insurance. Now, the next step up from term, of course, and sort of ignoring, I don't want to say ignoring, but like excluding at this point group coverage, right? This is all talking about individual coverage you go and purchase on your own, working with an insurance, broker or somebody that will underwrite a life insurance policy.
Mm-hmm.
The next step up then is what we call permanent insurance, which comes in a variety of flavors. Whole life being the most traditional sort of permanent insurance, but then there's also this terminology here, universal life. There's variable universal life. There's variable index life. There's all these sort of spins and takes on an insurance that is meant to be there no matter when that day that you pass on is. It is meant to be in force at that time.
Yeah, and we always like to focus on the fact that life insurance should be used for a specific need, not to, hedge something that's going to eventually happen. We know that
Right.
we are all going to pass away at some point. We know that, or we've seen in the past, that most folks tend to accumulate assets as our lives go on, and we have less need for permanent life insurance down the road when we have accumulated those assets. But some people do need permanent life insurance, maybe to cover a legacy need. Maybe they want to make sure that when they are no longer here, certain amount of dollars goes to their beneficiaries or a charity.
Yeah. And then there's also just the estate liquidity piece of this. This is where I think it's most important. There's two things that can create estate liquidity needs. One is if you have an estate that's over the estate tax threshold, right? And let's say those assets are, not necessarily easy to access, right? You're going to need something to come in and provide, right, the capital necessary to potentially pay some tax, right? So that's something you just, as part of your tax planning, you're looking at. And affordably, right, creating a resource pool for your beneficiaries so that they don't have to go and fire sale everything.
Yeah. Jason, I love that you had your little in there on the tax side of things with the estate taxes.
Oh, sure. Yeah. Well, I mean, it's less and less common. I mean, it's obviously a huge limit, but still something that's absolutely a consideration. And then on the other side of that, or I guess not other side, related to that would, of course, then just be, again, what is the character of your estate just in general? Are you passing on raw land or, right, property that's not easy to sell, et cetera, and that maybe you don't want your heirs to sell. Maybe you want them to keep it, in place. And so they need liquidity. They need money to support that, right, in some way. And so that's, again, where life insurance, again, lasting no matter as long as you do, comes into play to help you accomplish those goals.
Yeah, and a good example of why this comprehensive view is really necessary, because we just talked about a little bit of insurance, a little bit of tax, a little bit of estate planning here.
Yeah.
So really wrapping all of them together and making sure that whatever insurance you do purchase is going to suit all of those needs, not just a standalone insurance need, is really crucial here.
Yeah, absolutely. Now, Gen X and Y here, right? You are still in that phase, right, where it is more likely than not that you will have some sort of accident take place, right, that will prevent you from working and earning an income. And that is more likely to happen than you to, have an unfortunate demise, right, an early demise. And so this is where we pivot into now talking about disability insurance, right? Which is kind of the other side of, right? Life and disability sort of go hand in hand because these two sort of events that would impair, obviously, your financial means coming up and manifesting in different ways.
Yeah, and I've been referring to disability insurance lately as income insurance, because if something happens to you, you become disabled, you are no longer able to work or not able to work at the same level or in the same industry, using a specialization perhaps that brought you the dollars that you were previously earning. Disability happens, disability or income insurance can step in and provide at least a portion of that prior income to help you get through until you recover, or potentially until retirement age.
Right. I mean, some scenarios you do see that those benefits are paid all the way until you hit, Social Security eligibility, et cetera. Right. So it is. Yeah. I like the phrasing of income insurance. It's sort of like annuities being market insurance. Right. I mean, it's that same idea. Right. Is this is what you're actually protecting here. Unfortunately. Right. And I'm sure you see this plenty. Right. That there's just not a the same uptake, if you will, with disability insurance as there is with life insurance. And I don't know if that's just, based on some of the mechanics of how policy works. And sometimes disability insurance can be, more convoluted, potentially pricier, right? Because the risks are in theory higher, right? And so, yeah, but it's something that is really, really important to consider, especially if your employer doesn't provide disability insurance.
Or if you are more highly compensated and your employer caps that disability insurance at a certain dollar amount per month, but maybe you need more than that to support yourself or your family. So yeah, even layering on an individual disability policy on top of employer provided disability insurance, that can make a huge difference if something was going to happen to you, which Jason, you already mentioned. It's pretty likely that we're going to become disabled rather than pass away at an early, untimely age.
Yes, absolutely. Now, difference here between life insurance and disability insurance is, of course, disability insurance comes in kind of less flavors, if you will. It's a pretty standard type of thing. There isn't like a term versus permanent, et cetera. They're all, in theory, I guess they're all, quasi permanent term policies, right? I mean, there's sort of this element of the premium can go up because your income went up, right? And so there's all these different potential factors that come into play, but it's really just like, it's a more or less standard thing. I mean, every insurer is going to have their own caveats and little things, but you're not looking for whole disability versus term disability versus universal, right, et cetera.
Yeah, and as you get closer to retirement age, you might be able to drop a disability policy because you technically could retire as you really get close to that age. But for the most of working folks, it's a good idea to have some type of income insurance policy here. Usually going to replace between 50 to 70% of your income, depending on what type of policy you have.
And the thing I want to use to highlight something about life insurance is this lack of variability in disability insurance, right? This lack of sort of different types of policies. And that is simply that you use disability insurance or income insurance for that specific thing. The other thing that earlier we talked about with life insurance, as far as like all these different policy types and all these potential ways to use the insurance for something it's not necessarily designed for. So, you'll see often there's we can create, an education fund for your kids by using a life insurance policy. It's a life insurance policy. You can also separately fund your child's education. They do not need to be combined. And oftentimes they're not necessarily effective when they're combined in that way.
Yeah, I love that you pointed that out because using it for its purpose is huge here. And if you are thinking about this, maybe reach out, podcast@fpfoco.com. Share with us what type of insurance you've purchased and why. We might be able to do a quick analysis on a show to give an example of what you might want to do with that.
Yeah, share your thoughts.
Now, I want to move into one more type of insurance today. I mentioned this earlier. This is LTC or long-term care insurance. And this is a really interesting one because the older we get, the more expensive it gets because the more likely we are to need long-term care insurance down the road.
Right. And it's one of those things that is very clear for those actuaries to sort of discover that as you age, these sort of scenarios and circumstances, and you go into any care facility and you look, everyone in there is of advanced age, right? And so it's something that is very closely tied with your age as far as the cost goes. But then also at the same time, just the actual underlying service itself, the thing that it's paying for, of course, being incredibly expensive and very, numerous levels of potential need and cost involved.
Yeah, very involved healthcare costs a lot, as we've seen lately. Jason, I remember kind of my first foray into long-term care was looking at a price increase for a family member of yours who had bought a policy years and years ago and got a great deal on it. Then later, the insurance company started to realize, wow, this is costing a lot more than we had initially imagined. So these people who got these great deals, we're gonna have to charge them a little more so that we're not just paying out to cover these insureds.
And it happened so that even when those increases were in place, again, with some of these older policies, like you just can't find that type of coverage at that cost, even at the updated cost anymore. And so it's like, okay, they're increasing it, but it is reasonable to take on it. And then there becomes a point where you start to evaluate, like, what makes sense within the policy and how much do you need, lifetime benefits at the 100% of the payment amount, or could it be a different period of time, or a shorter period, or a lower amount for home care versus assisted living versus skilled nursing and so on. And so you can start to maybe tweak and tailor those policies, which is what we ended up ultimately doing, after several of those increases, just to get it more in line with what seemed reasonable cost-wise.
Yeah, and these long-term care policies now, if you are thinking about applying for one, in a lot of cases, they are prohibitively expensive. And that
Yeah.
brings me back to something I mentioned earlier is that, as we age, we tend to build assets. So we find anymore, a lot of these long-term care policies that we're recommending cover a portion of care per day, while folks rely on their assets to cover the remainder. The other piece of this is as these care policies become again, prohibitively expensive, we've been recommending that people rely on their homes, the value of their homes, if they were to have a long-term care need at some point in the future. They're not going to be living in their home because they'll be in that long-term care facility. So sell the home, rely on the value of the home to provide some of that care in those later years.
Yeah, it's really leveraging that home equity as an asset, right, that you could actually use within your financial plan, where otherwise most people don't, right? It's just sort of this thing that gets passed on, which, okay, that's fine. Like, I totally get the point of, like, we're reducing the value that's passed on to your heirs, but at the same time, we're doing it in a way that hopefully, like, this is identified as the asset that covers that. And then everything else is what we're preserving now, then at that point, going forward. So you sort of have this built-in insurance policy, if you will, in owning that home. Now, of course, with the increased costs in traditional long-term care insurance, of course, life insurance finds its way back into the mix here in the long-term care space. Right, Reggie? Tell our listeners a little more about this idea.
Yeah, and I alluded this to a little bit earlier. Like, if you have a long-term care need arise, you could use your home. A lot of the traditional long-term care policies are just for that, long-term care. Well, what if you've been paying for this policy for years, for decades, and you end up not needing long-term care? Well, everything you paid into your policy would help cover those who actually did need to rely on their policies. It's kind of how the insurance company would hedge their bets. But there is a type of long-term care coverage that, Jason, as you mentioned, is a hybrid with life insurance, so that as you pay into this policy, you know that if you don't need the long-term care component, that your beneficiaries or charities would receive the life insurance benefit when you are no longer around.
Right. So it's ultimately a thing that does not sort of just spend the dollars and never see any sort of return on it. Someone, whether it's your heirs, whether it's yourself, et cetera, will see a benefit out of that insurance policy.
Yeah, so you kind of get the ROI yourself, or it gets passed on to loved ones or charities that you care about. Well, with that, let's get into today's takeaways, and I will take us away with takeaway number 1, and that is, if you are considering a life, disability, or long-term care policy, start with disability. Ensure the income that you're already receiving, then consider whether you need a life insurance policy, and then maybe consider long-term care, especially in that life insurance construct with a potential hybrid policy.
Love that order of operations there. Takeaway number 2 for me here is use the insurance for what it's designed for, right? We're talking life insurance. Use it to ensure your life and your income earning, et cetera, potential. Disability insurance, of course, you're going to sort of be in a scenario where that's exactly what it's, designed to do. So make sure that you are not getting some, random policy like a life insurance policy with no long-term care provisions as part of your long-term care plan. Now, it might provide cash after you're gone, but it may not provide anything up front. So make sure that it has that piece in place as well, if that's what your needs lead you to.
And takeaway number 3, once you've decided on the right types of insurance that are right for you, tailor them to the amounts that are appropriate for your life, your lifestyle, and your family.
I dig it. I dig it indeed. And if you have any thoughts, tips, tricks, or other questions about life, disability, or long-term care insurance, feel free to reach out to us. You can email us at podcast@fpfoco.com. That will also be in the show notes, and you can find us at FPFoco on many of your favorite social media channels.
And for any clients who are listening in, a reminder that it is Insurance Planning Month here at FPFoco. So head over to the website and schedule some time with me if you'd like to discuss any types of insurance.
Well, that's fantastic. That's a great idea to take care of that. And hey, thanks for listening, and we will talk to you soon.
Jason Speciner and Regina Neenan are investment advisor representatives of FP FOCO, a registered investment advisor. The information in this podcast is provided for general educational and entertainment purposes only. It may not apply to you or your specific circumstances and should not be considered financial, investment, or tax advice.